Preparing for a financial analyst at T-Mobile interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you analyze T-Mobile's financial performance? I would start by linking the three statements. A financial analyst at T-Mobile should understand how subscriber growth, pricing, device costs, network investment, and financing flow through revenue, EBITDA, cash flow, and leverage. I would then test assumptions against operating metrics, investigate variances, and communicate a concise recommendation. The objective is not merely producing a report, it is explaining what changed, why it changed, and what management should do next. While answering, focus on revenue growth, postpaid customer trends, churn, ARPU, adjusted EBITDA, free cash flow, network investment, leverage, and explaining the operational drivers behind changes rather than simply reciting figures. Question 2. How would you forecast T-Mobile's revenue? At T-Mobile, I would forecast revenue by separating service revenue from equipment revenue. Service revenue would use customer additions, churn, ARPU, and pricing. Equipment revenue would reflect device volumes, upgrades, subsidies, and installment activity. I would build base, upside, and downside cases, reconcile them to historical trends, and stress test churn and ARPU. Finally, I would compare the forecast with management guidance and explain the operational assumptions driving any variance. Make sure to cover service revenue, equipment revenue, customer additions, churn, ARPU, pricing, device upgrades, installment activity, historical trends, management guidance, and base, upside, and downside scenarios. Question 3. What is the difference between EBITDA and free cash flow? EBITDA measures operating performance before interest, taxes, depreciation, and amortization, while free cash flow shows cash available after operating needs and investment. For T-Mobile, I would bridge EBITDA to cash by considering cash taxes, working capital movements, spectrum payments, capital expenditures, restructuring costs, and lease-related items. EBITDA is useful for comparing operations, but free cash flow better informs debt reduction and capital allocation. I would never treat them as interchangeable. In your answer, distinguish an operating profitability measure from a cash measure, and discuss taxes, working capital, capital expenditures, spectrum payments, restructuring costs, leases, debt service, and capital allocation implications. Question 4. How would you evaluate T-Mobile's network capital expenditures? I would evaluate network CapEx through both strategic and financial lenses. Strategically, I would assess coverage, capacity, 5G demand, customer experience, and competitive positioning. Financially, I would estimate incremental subscribers, ARPU retention, operating savings, asset life, depreciation, and the resulting return on invested capital. I would separate maintenance spending from growth investment and compare actual benefits with the original business case. That approach connects network quality to cash returns. Be sure to mention coverage and capacity needs, 5G deployment, customer demand, return on invested capital, incremental subscribers, avoided costs, depreciation, timing, regulatory obligations, and separating maintenance from growth capital. Question 5. Which operating metrics would you monitor for T-Mobile? I would monitor postpaid net additions, churn, ARPU, prepaid trends, service revenue growth, customer acquisition cost, upgrade rates, and network usage. I would pair those metrics with adjusted EBITDA margin, CapEx intensity, and free cash flow conversion. Churn and ARPU deserve special attention because a small change can materially affect customer lifetime value and forecast revenue. I would also compare T-Mobile's trends with competitors to distinguish company-specific performance from industry conditions. Focus on postpaid and prepaid net additions, churn, ARPU, service revenue, customer lifetime value, device upgrades, network usage, customer acquisition cost, EBITDA margin, CapEx intensity, and free cash flow conversion. Question 6. How would you analyze churn and its effect on financial results? Churn measures the proportion of customers leaving during a period, and it directly affects revenue visibility and acquisition spending. I would analyze churn by customer type, tenure, geography, plan, and cohort, then identify whether changes reflect pricing, service quality, promotions, or competition. I would quantify the impact on subscribers, ARPU, lifetime value, and acquisition costs. A modest churn increase can materially reduce forecast cash flow, so I would stress test it explicitly. Make sure to explain churn calculation, postpaid versus prepaid differences, retention drivers, customer lifetime value, revenue loss, acquisition costs, cohort analysis, seasonality, and sensitivity testing around small percentage changes. Question 7. Walk me through how the three financial statements connect. The income statement produces net income, which flows into retained earnings and begins the cash flow statement. The cash flow statement adjusts net income for non-cash items and working capital movements, then adds investing and financing activities to derive ending cash. Capital expenditures increase property, plant, and equipment, while depreciation reduces its carrying value and lowers earnings without using current cash. Debt, equity, and cash balances must reconcile across the balance sheet. Cover net income flowing into retained earnings and operating cash flow, non-cash adjustments, working capital, capital expenditures, debt and equity financing, ending cash, and balance sheet checks. Question 8. How would you investigate a forecast variance at T-Mobile? I would first define the variance precisely by comparing actuals with the approved forecast and isolating the affected line item and period. Then I would decompose it into volume, price, mix, timing, customer behavior, and cost drivers. I would validate the data, speak with the relevant operating team, and determine whether the issue is a forecast error or a genuine business change. Finally, I would update assumptions and communicate the financial and operational implications. In your answer, discuss defining the variance, separating price, volume, mix, timing, and foreign or external effects, validating source data, speaking with business owners, quantifying drivers, and recommending corrective action. Question 9. How would you evaluate synergies from a telecommunications merger? I would separate recurring cost synergies from revenue synergies and one-time integration costs. Potential benefits could include network rationalization, reduced duplicative infrastructure, procurement savings, improved customer retention, and broader coverage. I would assign each initiative an owner, timing schedule, probability, and measurable baseline. Then I would track realized EBITDA and cash benefits against the original case, avoiding double counting. Execution risk matters because delayed synergies can weaken leverage and valuation assumptions. Be sure to address cost and revenue synergies, network rationalization, subscriber retention, timing, one-time implementation costs, realization tracking, double counting, execution risk, and the impact on EBITDA and free cash flow. Question 10. How would you assess the financial attractiveness of a new network project? I would build an incremental cash flow model rather than allocating all company costs mechanically. The model would include required CapEx, operating expenses, expected subscriber and ARPU benefits, taxes, working capital, asset life, and any residual value. I would calculate NPV, IRR, and payback under several scenarios, then test demand, pricing, and construction timing. I would also identify strategic benefits that may not appear immediately in the standalone financial return. Focus on incremental revenue, avoided costs, capital requirements, operating expenses, taxes, working capital, useful life, terminal assumptions, NPV, IRR, payback, scenario analysis, and strategic benefits. Question 11. What leverage metrics would you monitor for T-Mobile? I would monitor gross debt, cash, net debt, adjusted EBITDA, net leverage, interest coverage, free cash flow, maturities, and refinancing needs. Net debt to EBITDA provides a useful headline measure, but I would review debt costs, fixed versus floating exposure, covenants, ratings, and cash flow volatility as well. For T-Mobile, leverage should be evaluated alongside network investment and shareholder returns. Strong recurring service cash flow can support debt, but not without liquidity discipline. Discuss gross and net debt, adjusted EBITDA, debt to EBITDA, interest coverage, free cash flow, maturity schedules, refinancing risk, ratings, covenant headroom, and how leverage affects capital allocation. Question 12. How would handset installment plans affect financial analysis? Handset installment plans can separate revenue recognition from cash collection. I would analyze device sales, installment receivables, subsidies, upgrade timing, financing costs, and potential credit losses. The income statement may recognize equipment revenue when the device is transferred, while cash arrives over several periods, creating working capital and balance sheet effects. I would therefore review equipment margins and operating cash flow together, ensuring customer economics remain attractive after promotions and acquisition costs. Mention equipment revenue timing, cash collection, receivables, device subsidies, upgrade behavior, financing costs, allowance risk, working capital, customer economics, and distinguishing accounting earnings from cash generation. Question 13. How would you analyze working capital at T-Mobile? I would examine accounts receivable, inventory, accounts payable, device financing balances, and related cash conversion trends. Receivables could rise from customer growth or slower collections, while inventory may reflect seasonal launches, upgrade activity, or overstocking. I would compare days metrics with historical patterns and operating drivers, then distinguish structural changes from quarter-end timing. The conclusion should explain whether working capital is consuming cash temporarily or signaling a broader operational issue. Focus on receivables, inventory, payables, device financing, supplier terms, customer collections, seasonal upgrades, working capital ratios, cash conversion, and distinguishing sustainable changes from timing-related movements. Question 14. How would you build a downside case for T-Mobile? I would build the downside from operational assumptions, not apply an arbitrary percentage reduction. I might assume slower postpaid additions, modestly higher churn, lower ARPU from promotions, delayed synergies, elevated device costs, and higher network spending. I would translate those assumptions into EBITDA, free cash flow, leverage, and liquidity impacts. Then I would identify mitigations, such as reducing discretionary spending or pacing capital returns, and present the key sensitivities transparently. Be sure to include weaker customer additions, higher churn, lower ARPU, promotional pressure, slower synergy realization, higher CapEx, inflation, refinancing costs, liquidity, and clearly defined management actions. Question 15. Which valuation methods would you use to analyze T-Mobile? I would use a DCF and market-based cross-checks. In the DCF, I would forecast service growth, margins, CapEx, taxes, working capital, and terminal value, then discount unlevered free cash flow. For comparables, I would examine enterprise value to EBITDA, free cash flow yield, growth, leverage, and network quality across relevant telecom peers. I would explain why each method may differ and use valuation ranges rather than presenting false precision. Discuss discounted cash flow, trading comparables, precedent transactions, enterprise value to EBITDA, free cash flow yield, subscriber economics, growth, margins, leverage, and appropriate peer selection. Question 16. How would you use Excel and data tools in this role? I use Excel to build transparent models with clearly separated inputs, calculations, outputs, and validation checks. I am comfortable with formulas, pivot tables, lookups, scenario analysis, and sensitivity tables, and I would use SQL or business intelligence tools when larger datasets require repeatable analysis. I document sources and assumptions, check totals against reported results, and review unusual outputs before presenting them. A fast model is only useful if stakeholders can trust it. Mention structured models, clean source data, pivot tables, lookups, scenario controls, checks, sensitivity tables, automation, SQL or BI tools where relevant, documentation, and reviewing outputs before sharing. Question 17. Tell me about a time you disagreed with a business partner's forecast. In a previous project, a business partner forecast unusually strong customer growth based on a promotional campaign. I listened to the rationale, then compared the assumption with historical conversion rates, cohort performance, and comparable campaigns. Rather than rejecting the forecast, I proposed a base case and an upside case with clear milestones. We agreed to monitor early results and update the model. That approach preserved the relationship while making the forecast more decision useful. In your answer, describe the specific disagreement, evidence used, listening skills, collaborative validation, respectful communication, revised assumptions, measurable outcome, and maintaining the relationship after the decision. Question 18. What would you do if a dashboard showed an unexpected decline in subscribers? I would not immediately assume the decline reflected actual customer losses. First, I would validate definitions, reporting dates, source system feeds, and recent data changes. Then I would segment the result by postpaid or prepaid, geography, channel, plan, and tenure, while checking churn, gross additions, and billing data. I would contact the data and business owners, quantify the revenue impact, document the root cause, and escalate promptly if the result remained material. Cover validating definitions and data integrity, checking timing and source systems, segmenting customers, comparing related metrics, contacting owners, quantifying financial impact, documenting findings, and escalating material issues. Question 19. How would you explain a complex financial result to a non-finance executive? I would lead with the conclusion, then explain the 2 or 3 drivers that matter most. For example, I might say service revenue exceeded plan because stronger customer additions more than offset lower ARPU from promotions. I would quantify the impact, distinguish actual results from forecast assumptions, and use a simple bridge or chart rather than finance jargon. I would end with the decision required, such as revising guidance or adjusting promotional strategy. Focus on leading with the conclusion, using plain language, linking financial outcomes to operational drivers, quantifying material impacts, separating facts from assumptions, using concise visuals, and ending with an actionable recommendation. Question 20. Why do you want to be a financial analyst at T-Mobile? I want this role because T-Mobile combines a recurring revenue business with meaningful operating complexity. Subscriber growth, churn, pricing, device economics, network investment, and capital allocation all create opportunities for rigorous analysis. I am attracted to a company where financial work can directly influence commercial and operational decisions, not just historical reporting. My strengths are structured modeling, curiosity about business drivers, and clear communication, which would help teams turn data into practical actions. Be sure to connect T-Mobile's subscriber-focused business, competitive wireless market, 5G investment, recurring cash flows, analytical complexity, cross-functional exposure, personal strengths, and specific contribution to informed decisions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.